Hey everybody, Joel Powell, Brian Hunt. Welcome to another episode of 60 Seconds of Risk. And today we're going to talk about financial metrics, and specifically ones you might hear about a lot in, well, every industry, but construction for sure. And that's the concept of working capital. People say, hey, what's your working capital? Don't have your working capital tied up. Do you have enough working capital? Well, the question is, how do you measure working capital? That's what we're going to talk about today real quick. So the standard definition of working capital is current assets minus your current liabilities to get to your working capital. In this situation, then you got to break it down into two parts. First, what's a current asset? Current asset are those things you have that you can get access quickly to, or liquidate quickly, or you expect to receive in a short amount of time. And let me talk about a couple things. Obviously, you've got cash. That's pretty simple. Cash sitting in your banking account, maybe money markets accounts. That's liquid. You've got it. Inventory. Those are things that we typically talk about. Don't have your working capital tied up on too much inventory. Inventory is consistent with your cash, especially if you're going to plan on selling it to your customers, like cars or steel or computers, whatever the case may be. You built it with anticipation of selling it, so that's kind of got your assets in your inventory. Other component is accounts receivable. You've already billed your clients, they've received it, now you're just waiting for the money to come in, and hopefully it's going to come in within 30 days. That's a current asset. So the flip side of that, what's a current liability? Well, first thing is accounts payable, because you might have, in order to get that inventory, you might have had some bills you had to pay for your suppliers or along the lines, electricians, whatever. So you got accounts payable. Wages, think about the wages as, say, if you pay your employees once a month, and you know you've got a big pay, like you're 3 weeks away, you know you got that pay due come pretty soon, so you want to accrue for that and understand that what your wages are as far as these are short-term liabilities. And then also current debt, and that means things that you're going to have to pay in the next 12 months. Now this could be the next 12 months of a 30-year note. You're not going to consider the entire mortgage or long-term note as part of your current assets. You're talking about those things you have to pay within 12 months. So current assets minus current liabilities equals working capital. Let's give you an example of how that might look. Let's say, for the purpose of conversation, you've got current assets of $1,500, and you've got current liabilities of $1,000. So, following the math, assets minus your liabilities, that means you've got a positive working capital of $500. Positive is good. That's basically telling you you've got excess assets to pay all of your current liabilities. Now the flip side is that if this is a negative number, that would be bad, meaning that you're burning through cash and you don't have enough to pay your current liabilities. So positive good, negative bad. But the question is, that's a number, great, but how do I compare it? What's my ratio? Well, what we can do here is change this entire formula in concept is no longer just being a working capital, strictly current assets minus current liabilities. We could turn this into a ratio. And a ratio allows you to sort of get a snapshot as far as a metric of where you might be at any given time. So let's sort of change this. Let's go back to saying we had current assets of $1,500, and again, liabilities of $1,000, but we're not subtracting the two, we're going to divide the two. So really, no longer are we going to do this, but going back to our algebra, current assets divided by current liabilities. Now in this situation, we would get current assets divided by current liabilities, we would get a ratio of 1.5. Just so you know, that's a good number. And the actual range you want to see for working capital is 1.5 to 2. If you've got 1.5 to 2, you've got a nice mix of current assets, you're feeling good, you can pay your short-term liabilities. And truly, you might say, oh, I want a larger number than this. Not necessarily the case, because if you've got a really large working capital number or ratio, what that really means is you've got a lot of money tied up in that in cash. And remember, the purpose of business is to make more money than, say, the risk-free rate, which is cash sitting in the bank. So the purpose, if you've got a lot of cash in the bank, it should be really deployed in acquisitions, buying equipment, expansions, payroll, getting new people, increasing your staff. This is what you want to do. Keep it to 1.5 to 1.2. If you're less than 1, really 1, if 1 really means you got $1 for every liability, I guess that's fine, but you really want to be closer to 1.5. But if you're less than 1, that means you've got more debt than you have assets, and you want to get that changed and turned around as soon as possible. Because like all things, cash is king, and if more, when a nice mix of cash or liquid assets sitting on your books, so that if something goes wrong, you know you can pay your short-term liabilities. Like all things, guys, I hope you enjoy this. If there's a certain topic or individual you want to see on this, please let me know. Post that on LinkedIn or send me a message. You can also subscribe to this channel on YouTube. You can also find links to these videos on Substack and Twitter. Until next time, guys.